My name is Sriram. I'm a professor at the Center for Public Policy in IIM Bangalore.
All right, what is financial inclusion to begin with? Can you dumb it down?
Financial inclusion is trying to provide formal financial services to the people who have not had access to formal financial services. Basically, that's the broad definition. In fact, financial inclusion as a term was coined by Dr. Y.V. Reddy in the 2005 credit policy. And inclusion as a term was coined not because he wanted to coin the term inclusion, but the whole idea was to say how do we get people who are excluded from the formal financial services into the mainstream. That is the reason why the financial inclusion as a term got coined. Before that, multiple things have been used. Microfinance has been used, small finance has been used, credit for marginalized people has been used, deposits has been used. But as a technical term, it came about around 2005 when the credit policy was announced. The idea of financial inclusion is to get people who are not having access to formal financial services into mainstream regulated financial services. That's the basic idea. Beyond that, there are some broad objectives of financial inclusion, which includes the moment you get people into the formal financial services are regulated, so therefore the contracts could be non-exploitative. People who are weaker in the contracting party could have some rights, and also anything that is formal results in data, and anything that has data will result in better and precise policy making. So broadly, that's the broad idea of financial inclusion.
And where are we standing as India today in terms of financial inclusion?
We've done fairly well. The way we look at financial inclusion is it is a moving target. So when we initially started off as financial inclusion, the traditional understanding of financial inclusion was poor who need access to credit at affordable rates. And broadly, that was the base level understanding of financial inclusion. The counterpoint to that was people who are poor are often exploited by informal money lenders, and they charge usurious interest rates, and therefore that is the narrative that the policy was trying to address for a long time. So all your policies from pre-independence all the way till about mid-90s was about making credit accessible and favorable terms to the poor. So that was a minimalistic definition of what financial inclusion was. Somewhere around 1990s, with the advent of microfinance in Bangladesh and in India, self-help groups and so on, the shift happened to include savings over a period of time, and savings was also a part of the financial inclusion narrative. That went on to add more services. In fact, around mid-2000s, Dr. K.C. Chakrabarty, the then Deputy Governor of Reserve Bank of India, had a definition which encompassed savings, credit, post-retirement, social security measures, insurance, risk mitigation, and so on. So in that sense, financial inclusion story is a moving target. We are doing fairly well as far as this moving target is concerned.
All right. Just double clicking on microfinance, what does it actually mean, and what is the role of MFIs in the process of financial inclusion?
MFIs are a small part of the financial inclusion story. What MFIs did or microfinance did was redefined credit in a different manner. Actually, if you were to look at formal financial services, the centerpiece for a long time in the policy was banks. Microfinance came in a very peculiar way around the mid-70s across the world. I mean, it's not just India, it came across the world, where it was largely led by the not-for-profit civil society organizations who kept on saying that, look, formal financial services through banking is not working, essentially because it is all about access. Banking is trying to provide formal financial services at affordable rates, and what they defined as affordable rates, and therefore because the policy defined affordable rates as low interest rates, it was not interesting for any commercial organization to tap this market, and therefore whatever market that was being tapped as an obligation rather than as a market opportunity. What the civil society organizations did was they changed the narrative to say that, look, it is not about low interest rate, it is about access. They put access as a primary thing. So When that happened, the civil society organizations started forming these groups, started in India with the self-help groups and in Bangladesh with the Grameen groups. And around the same time, it happened in Latin America, South Africa, Philippines, Indonesia, all over the place. I think the civil society organizations have a way of, communicating that messages amongst themselves. So there were multiple models that came about, which put access in the center and put interest rates on the side, and they said it's okay for small ticket transactions, high interest rates are fine as long as you're providing access and dignified access to financial services. So that's how the entire microfinance movement came about. And it also changed the paradigm a little bit, because from men centric, the large portion of the South Asian microfinance was women centric. They said that these are the people who would do. Partly because the methods was calling for a group meeting, aggregation of transactions, and possibly with the gender relationship, women possibly had more time to address this issue and participate in the meetings. So that's how the emergence of microfinance happened. What happened over a period of time is, with the emergence of microfinance, with this model where they said that interest rates are irrelevant as long as they are transparent, the civil society organizations also discovered that there is fair amount of profit in this, because some of the assumptions that they started out with, that there would be very high administrative costs and there would be very high default costs, did not turn out to be true. These portfolios performed fairly well, and therefore that resulted in profit. So as a result of which, people who are profit oriented also started coming into this market. People who are civil society organizations converted themselves into for-profit organizations in order to grow and scale, and thereby stands the story of the microfinance. This thing, microfinance in India is predominantly credit driven. It's not savings driven. It's predominantly credit driven, and it's predominantly stripped down one product or a couple of products. It's not a very complicated thing.
Understood. Can you break down DPI and DPG for us as of today and the role they play in inclusion?
There are two bits of DPI which seem to be working here. One is the entire Aadhaar infrastructure, other is the entire UPI infrastructure. That's what is predominantly working the financial inclusion space. What has Aadhaar done? Aadhaar has given everybody a common identity. I mean, it's not that people did not have identity. They all had identity document, but making Aadhaar a primary identity document, it has become easier for you to deduplicate and therefore ensure that there is a uniqueness in the data that is linked to a particular Aadhaar number. So that is one bit, and that has come completely costless to the borrower. So therefore, it's become easier for the borrower or anybody participating in the financial market to establish their identity, one, and if that identity is established to transaction trail, then that's possible for you to allow others to use that. So that's one bit. Second is also in terms of how money is transacted and how payment structures are made. UPI has turned out to be the second biggest inclusion initiative. So these two are the big cornerstones possibly in the future of tech-led financial inclusion.
How can we look at financial inclusion as a business opportunity?
If you're looking at financial inclusion as a business opportunity, it was always a business opportunity, except that the markets were not looking at it as a business opportunity, essentially because there was orthodoxy about the interest rate. The moment you charged anything more than what you charge for the prime borrower, people would say you're exploiting. Interest rates are a function of the tenor of the loan, the size of the loan, and the type of security and the underlying risk. So therefore, comparing interest rates for the inclusive customers along with prime corporates is an unfair comparison, or with housing loan is an unfair comparison. What the civil society organizations did was they removed this taboo over high interest rates, and said that this is a fair interest rate. Once the fair interest rate was established, the for-profit organizations started coming in. The bit that is not fully solved and cannot be easily solved is the savings bit. I think we've got anything that you can push to the customer, that technology can handle, but anything that the customer has to push to the system, the technology is still not handling. I think that is the next big innovation that needs to happen, and I don't know where we are going ahead as far as that is concerned.
All right. Thank you. Thanks so much for your time.